Something fundamental has shifted in the physical silver market, and most people watching financial news have completely missed it. This isn't about price predictions. It's not about overnight wealth or market crashes. This is about a structural change that's been building quietly for years and has now reached a critical threshold. If you hold physical silver, you need to understand what's happening beneath the surface of the price charts. If you don't hold silver, but you've been paying attention to inflation, currency instability, and the growing tension in global markets, what's unfolding right now deserves your careful consideration. The bottleneck we're going to discuss today isn't temporary. It's not a short squeeze or a social media-driven frenzy. It's a supply and demand imbalance that has roots in industrial consumption, investment demand, mining constraints, and monetary policy decisions that have distorted markets for over a decade. I'm going to walk you through this situation the way an experienced analyst would explain it to a colleague over coffee. Clearly, calmly, and without the noise. We'll look at what has changed, why it matters, how historical patterns help us understand what might come next, and most importantly, how thoughtful investors should think about this moment. This conversation is for people who value understanding over excitement. If you're looking for someone to promise you riches by next Tuesday, you're in the wrong place. But if you want to understand a genuine structural shift in a critical market, stay with me. Let's begin with the reality on the ground. Physical silver markets are experiencing something they haven't faced in modern memory, a sustained, widening gap between paper price and physical availability. Walk into most major bullion dealers today, and you'll notice something unusual. Premiums, the amount above spot price that buyers pay for physical metal, have remained elevated for an extended period. In normal markets, these premiums compress during periods of low demand and expand briefly during buying surges before normalizing. That normalization isn't happening this time. Delivery times have extended. Product availability has become inconsistent. Refiners and mints report persistent backlogs. These aren't the characteristics of a healthy, liquid physical market. These are the markers of a supply system under continuous strain. Here's what most commentators miss. This isn't being driven primarily by retail investors, panic buying. That happened in 2020 and 2021, and yes, it created temporary disruptions, but those were demand shocks, sudden, emotional, and ultimately self-correcting. What we're seeing now is different. It's a structural mismatch between long-term supply availability and sustained demand from multiple sources simultaneously. The silver market has three major demand pillars: industrial consumption, investment demand, and jewelry and silverware. For decades, these pillars operated somewhat independently. Industrial users bought what they needed. Investors came and went in waves. Jewelry demand followed cultural and economic cycles in specific regions. Today, all three pillars are pulling from the same limited supply at the same time, and that supply cannot expand quickly enough to meet the combined demand. Silver mining is not like flipping a switch. When prices rise, the natural economic response should be increased production. Miners should ramp up operations, new projects should come online, and supply should eventually meet demand. This is basic economics, and it works well in many commodity markets. Silver doesn't follow this pattern as cleanly as people assume. First, roughly 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means silver output is largely determined by the economics of those other metals, not by the silver price itself. A copper mine doesn't dramatically increase production just because silver prices have moved higher. The mine was built to extract copper, and silver is a secondary benefit. The production rate is determined by copper demand, copper prices, and the specific geology of the deposit. This creates a fundamental constraint. Primary silver miners, those who mine specifically for silver, represent only about 30% of global supply. That's a relatively small portion of production that responds directly to silver market signals. Second, bringing new mining capacity online takes years, not months. From discovery to production, a new mine typically requires 7 to 10 years of development. That includes exploration, feasibility studies, permitting, financing and construction, and ramp-up. Even if silver prices incentivize massive new investment today, the supply response wouldn't materialize until the 2030s. Third, many existing mines are aging. Ore grades, the amount of silver per ton of rock, have been declining at many operations. This means mines must process more material to produce the same amount of silver, increasing costs, and limiting the ability to expand production profitably. Some analysts who've studied mining economics point out that we're in an unusual situation. A decade of underinvestment in new projects combined with natural depletion of existing reserves. The supply pipeline is thin. Meanwhile, recycling, which could theoretically help balance the market, has its own limitations. Unlike gold, much of the silver used industrially is consumed in applications where it's dispersed in tiny quantities. Electronics, solar panels, medical applications, and industrial catalysts use silver in forms that are economically difficult or impossible to recover. The silver in a smartphone or solar panel isn't coming back into the supply chain the way old jewelry might. So we have a supply side that's structurally constrained, slow to respond, and facing natural depletion pressures. Now let's look at what's happening on the demand side. Industrial demand for silver has undergone a significant transformation over the past decade, and this change is accelerating. Silver's unique properties, it's the most conductive metal for both electricity and heat, highly reflective, and naturally antimicrobial, make it irreplaceable in many modern technologies. The solar energy build-out represents the most dramatic shift. Each solar panel requires silver for the photovoltaic cells that convert sunlight to electricity. As governments worldwide have committed to renewable energy targets, solar installations have grown exponentially. This isn't a temporary trend subject to reversal. Nations have made multi-decade commitments to energy transition. The solar industry's silver consumption has grown from a minor factor 15 years ago to one of the largest sources of industrial demand today. Electric vehicles represent another growing demand source. EVs require significantly more silver than traditional vehicles due to their electrical systems, battery management, and charging infrastructure. As the automotive industry shifts toward electrification, driven by both regulation and consumer demand, this structural demand continues to build. Then there's the broader electrification of everything. 5G networks, artificial intelligence, data centers, expanding electrical grids, and the growing Internet of Things all require silver in various components. These are not cyclical demands that will disappear during economic slowdowns. They represent the infrastructure of modern digital economies. Here's the critical point. This industrial demand is relatively price inelastic. A solar panel manufacturer cannot choose to use less silver if prices rise. The panel requires the silver it requires to function. The manufacturer faces a binary choice: pay the price or don't build the panel. This is fundamentally different from investment demand, which is highly sensitive to price and sentiment. So industrial users are pulling more physical silver from the market each year, and they cannot easily reduce that demand. Now add investment demand to this equation. After more than a decade of unprecedented monetary expansion, investors globally are reassessing their exposure to hard assets. This isn't just about inflation, though inflation is certainly part of the story. It's about trust in monetary systems, concerns about debt sustainability, and the search for assets that exist outside the banking system. When investors turn to precious metals, they typically start with gold as the primary monetary metal. But silver offers something gold doesn't: affordability and industrial utility combined with monetary properties. For investors with smaller capital bases, silver provides meaningful exposure to the precious metals thesis at a fraction of the cost per ounce of gold. This accessibility factor drives substantial retail and small institutional buying. We've also seen a shift in how people think about physical possession. The events of 2020 and the financial system stresses revealed something important to many people. Physical assets you control directly have different characteristics than financial claims on assets. This realization hasn't disappeared. It's settled into a sustained, lower intensity demand that persists regardless of short-term price movements. Finally, there's a growing recognition among certain institutional investors and sovereign entities that silver has been undervalued relative to gold for an extended period. The historical gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has reached extremes that some experienced analysts find difficult to justify based on fundamentals. Whether that ratio corrects or not, the attention it draws brings new buyers into a market with limited physical supply. Here's where the situation becomes particularly important to understand. The silver price you see quoted on financial networks is primarily determined by trading in paper contracts, futures and options on exchanges, and over-the-counter derivatives. These instruments allow enormous amounts of notional silver to be traded without any physical metal changing hands. This is not inherently problematic. Paper markets provide price discovery, liquidity, and risk management tools for producers and large consumers. They serve legitimate economic functions. But these paper markets can operate somewhat independently from the physical market, at least in the short to medium term. When traders buy and sell futures contracts, they're trading obligations and rights, not metal. The vast majority of these contracts are closed out before delivery, meaning actual physical settlement rarely occurs. This system works smoothly when physical supply is adequate and the market trusts that metal is available if needed. But when physical supply tightens, when refiners have backlogs, when dealers struggle to source inventory, when delivery times extend, a tension develops. The paper price might say silver is worth X dollars per ounce, but if you want to buy physical silver, you're paying X plus a significant premium, and you're waiting weeks or months for delivery. This disconnect signals something important. The paper market and the physical market are telling different stories. Experienced observers of commodity markets know this pattern. It typically appears when a physical shortage is developing but hasn't yet been fully reflected in the financial price. The premium expansion is the market's way of rationing scarce physical supply. In a healthy market, this premium eventually pulls the futures price higher, or increased supply comes online and premiums compress. One way or another, the markets reconcile. What makes the current situation notable is the persistence of elevated premiums despite the passage of time. That persistence suggests the supply constraint is genuine and not easily resolved. Some people look at the silver futures price and conclude the market is calm and stable. Others look at physical premiums, delivery times, and refinery backlogs, and see a market under continuous stress. Both observations are accurate. The question is, which one matters more for the medium to long term? For anyone holding physical silver, this distinction is crucial. Your metal exists in the physical world, not as a ledger, entry, or contract. Its value isn't determined solely by the paper price. It's determined by what someone will pay you for actual deliverable metal. For those considering entering the market, understanding this divide helps explain why buying physical silver has become more expensive and sometimes more complicated than the spot price might suggest. The bottleneck we're discussing is fundamentally a physical phenomenon. It's about metal, refineries, mints, transport, and storage, not about trading screens and contract specifications. Financial markets move in cycles, and understanding those cycles provides crucial context for evaluating the current situation. Silver has a particular history worth examining. It's experienced several major moves in the past century, each driven by different catalysts but sharing certain characteristics. The 1970s saw silver rise from roughly $2 per ounce to over $50 by 1980. That move was driven by inflation, monetary uncertainty, geopolitical instability, and eventually concentrated buying by specific investors. The peak was a mania that ended badly for late buyers. The 2000s saw another significant move from under $5 in 2001 to nearly $50 in 2011. That cycle was driven by the financial crisis, aggressive monetary stimulus, negative real interest rates, and growing investment demand. Again, the peak represented excessive speculation that corrected sharply. Both of these cycles followed similar patterns: a long base building period, a steady rise driven by fundamental factors, an acceleration phase as momentum buyers entered, a parabolic blow-off top driven by emotion and leverage, and a painful correction that gave back most gains rapidly. The investors who profited were those who entered during the base building phase or early rise, understood what was driving the move, and had the discipline to take profits before the mania peak. The investors who suffered were those who arrived late, bought based on excitement rather than analysis, and held through the collapse expecting an immediate rebound. Where are we now in the current cycle? This is the question thoughtful investors are asking. We're clearly not in a mania phase. There's no mainstream media frenzy, no dinner party conversations about silver riches, no late-night infomercial blitz pushing people to buy. We're also past the early accumulation phase. Silver has been on the radar of informed investors for several years now. The fundamental case has been building since at least 2020, when pandemic-related disruptions combined with extraordinary monetary stimulus. By many measures, we appear to be in a middle phase, past the point where only contrarian early adopters are interested, but before the momentum and emotional buying that characterizes late-cycle behavior. This middle phase is actually when the most significant sustainable gains often occur in commodity markets. It's the period after the fundamental case has been established, but before speculation dominates price action. Historical patterns suggest that during this phase, physical markets often begin showing the kind of stress we're observing now. Industrial users compete more aggressively for supply. Investment buying becomes steady rather than episodic. Price volatility increases, but without consistent upward momentum that would signal a final blow-off. It's an uncomfortable phase for investors, because it doesn't feel exciting. There's no validation from mainstream attention. The move isn't smooth. There are frustrating corrections and consolidations. Doubt creeps in during sideways periods. But it's also potentially the most important phase for long-term positioning. The analysts and investors who've studied previous commodity cycles recognize this pattern. They know that the truly significant moves often develop during periods when most people have become disinterested or skeptical. None of this means silver must follow the previous cycle patterns exactly. Markets are not algorithms, and history provides context, not prediction. But the patterns offer useful frameworks for thinking about where we might be and what might come next. The bottleneck we're discussing, the physical supply constraint, fits the profile of a middle cycle development. It's a structural problem becoming increasingly apparent to industry participants and informed investors, but not yet recognized broadly. Let's address those of you who already hold physical silver directly. First, the structural supply constraint validates a key element of your original investment thesis. You likely acquired silver because you wanted exposure to a hard asset outside the banking system, something with intrinsic value and utility. The fact that physical metal is becoming harder to source strengthens that positioning. Your metal exists. It's not a promise or a contract. It's actual elemental silver that cannot be created through monetary policy or dissolved through financial system stress. In a world where the distinction between real assets and financial claims matters, you're holding the real asset. The elevated premiums and extended delivery times you're observing at dealers tell you something important. If you wanted to acquire more silver today, you'd pay significantly more than you paid if you bought earlier. In that sense, your earlier purchases were well-timed relative to physical availability. But here's what you must not do. Become complacent or emotionally attached to the thesis. The fact that a bottleneck exists doesn't guarantee the price will rise dramatically or that it will rise on your preferred timeline. Markets can remain disconnected from fundamentals longer than seems rational. Physical constraints can persist without immediately impacting financial prices. Your edge is that you hold the physical asset. If the disconnect between paper and physical markets continues to widen, or if industrial users begin competing more aggressively for available supply, your position has optionality that paper traders don't enjoy. But optionality is not certainty. You still need to think about position sizing, diversification, and personal financial planning. How much of your total portfolio is in physical silver? For most investors, precious metals should represent a meaningful but not dominant position, something substantial enough to matter if the thesis plays out, but not so large that price volatility creates emotional distress or financial strain. The rule of thumb that experienced investors often cite ranges from 5 to 20% of investable assets in precious metals combined, with individual circumstances determining where in that range makes sense. If you're significantly above that range, you might be taking more concentration risk than is prudent. Are you holding for the right reasons? If your thesis was purely about short-term price appreciation, and the price hasn't moved as expected, frustration is natural. But if your thesis was about long-term purchasing power protection, portfolio insurance, or exposure to a supply-constrained asset, then the current situation actually reinforces your reasoning. Be honest with yourself about your emotional state. If checking the silver price daily creates anxiety, you're probably overpositioned or overfocused. The investors who do best with physical assets are those who can hold them calmly through volatility and noise. One more crucial point. The illiquidity of physical silver can work both for and against you. It's harder to panic sell physical metal than it is to dump an ETF or futures position, which can be an advantage during periods of fear. But it's also harder to exit quickly if your personal circumstances change and you need liquidity. Make sure your emergency funds and near-term liquidity needs are handled elsewhere. Physical silver should be part of your long-term positioning, not your operating capital. The bottleneck situation suggests patience may be rewarded, but patience only works if you're financially stable enough to exercise it. Now, let's talk to those who don't currently hold physical silver, but are trying to understand whether this situation warrants action. The first question you should ask yourself is not, should I buy silver, but rather, what problem am I trying to solve? If you're concerned about inflation eroding your purchasing power, silver is one potential solution, but it's not the only one. Real assets more broadly, including real estate, commodities, inflation-protected securities, and equity ownership in productive businesses, all offer different approaches to inflation protection. If you're worried about financial system stability or currency debasement, then hard assets you control directly have particular appeal. Physical silver and gold serve this purpose uniquely. If you're trying to capture potential upside from a supply-constrained commodity, then understanding the specific dynamics we've discussed becomes essential. The point is that silver isn't appropriate for everyone, and it shouldn't be purchased just because it seems exciting or because someone online is promoting it. Assuming you've thought through your objectives and concluded that exposure to physical silver makes sense for your situation, here's what the current bottleneck means for you practically. First, expect to pay elevated premiums. The days of buying physical silver close to spot price are likely behind us for the foreseeable future. This isn't market manipulation or dealer gouging. It's supply and demand expressing itself in the physical market. Those premiums represent the real cost of acquiring metal in a supply-constrained environment. They should factor into your cost basis and return expectations. Second, be prepared for extended delivery times and product availability issues. If you're buying from reputable dealers, they're sourcing from a strained supply chain. Patience is required. Third, understand that entering a market with a recognized bottleneck means you're not getting the early positioning that the most successful investors achieved. That doesn't mean the opportunity isn't valid. The middle phase of a cycle can still offer significant potential, but your risk-reward profile is different than it was for those who positioned earlier. You're buying into a recognized thesis, not discovering an overlooked opportunity. That distinction matters for expectations. Fourth, consider averaging in rather than making a single large purchase. The volatility in precious metals can be substantial, and spreading purchases over time helps reduce timing risk. This is especially prudent when premiums are elevated. You don't want to buy a large position just before a short-term correction. Fifth, Make sure you're dealing with reputable dealers and have a plan for storage. Physical silver takes up space and weight. $20,000 in silver is roughly 500 ounces, which weighs over 30 pounds and has volume. Are you storing at home, in a safe deposit box, using a secure storage facility? These logistics matter, and perhaps most importantly, go into this understanding that physical silver is not a trading vehicle. The premiums, transaction costs, and illiquidity make frequent buying and selling impractical. This is a positioning decision, not a trade. If you decide to purchase physical silver given the current bottleneck situation, you should be prepared to hold it for years, through volatility and uncertainty, until either your thesis plays out or your personal circumstances change. That requires a different mindset than most investment decisions. It requires conviction balanced with patience and emotional discipline when prices move against you. To understand why the silver bottleneck matters now, we need to zoom out and look at the broader macroeconomic environment. We're living through a period of extraordinary debt accumulation, both public and private, across most developed economies. Total debt to GDP ratios in major economies have reached levels that historically resulted in either default, inflation, or financial repression. Central banks have responded to successive crises over the past 15 years with aggressive monetary expansion. Interest rates were held near zero for over a decade, and when problems emerged, the solution was consistently more stimulus, more liquidity, more intervention. This has created distortions throughout financial markets. Asset prices have been inflated by cheap credit. The traditional relationship between risk and return has been disrupted. Investors have been pushed further out the risk curve searching for yield. Now, with inflation proving more persistent than central banks expected, we're in an uncomfortable transition. Interest rates have risen from emergency lows, but debt servicing costs have increased dramatically. The economic pain from truly restrictive monetary policy would be severe, yet allowing inflation to run hot erodes purchasing power and creates social instability. Central banks are caught between competing pressures, with no clean solution. In this environment, hard assets with limited supply become increasingly attractive to investors who understand monetary history. When there's tension between the amount of currency in circulation and the quantity of goods and productive assets, those with pricing power or supply constraints tend to perform well. Silver sits at an interesting intersection. It's a monetary metal with thousands of years of history serving as money, but it's also an industrial commodity with growing demand from technologies essential to modern economies. This dual nature means silver responds to both monetary concerns, inflation, currency debasement, financial system stress, and real economy factors, industrial production, technological adoption, supply chain dynamics. The bottleneck we're discussing emerges from this intersection. Investment demand, driven by monetary concerns, combines with industrial demand, driven by technological and economic forces. Both pull from the same constrained physical supply. The macroeconomic backdrop suggests these pressures are unlikely to resolve quickly. Governments aren't going to dramatically reduce debt. Central banks aren't going to embrace truly tight monetary policy if it means triggering recessions. The transition to renewable energy and electrification will continue regardless of economic cycles. This doesn't guarantee any particular outcome for silver prices. But it does suggest the structural supply-demand imbalance has a sustained fundamental basis, not just temporary speculation. Thoughtful investors are paying attention to these macro forces, not because they predict exact outcomes, but because they indicate where stresses in the system might express themselves. Understanding what not to do is often more valuable than knowing what to do. Let's talk about the mistakes you must avoid if you're engaging with the silver market in the current environment. First, do not react emotionally to short-term price movements. Silver is volatile. It can drop 10% in a week on no particular news, then rise 8% the next week. If you're going to hold physical silver, you must be prepared for this volatility without panicking. Every significant correction will feel like the thesis has broken. Every rapid rise will feel like you should buy more immediately. Both impulses are usually wrong. Emotional decisions in volatile markets consistently destroy wealth. Second, do not over-leverage or use margin to buy silver. The appeal of leverage is obvious. If you're right, you make more money. But in volatile markets, leverage is the fastest way to get wiped out. Physical supply constraints don't prevent sharp price corrections driven by paper market dynamics or forced liquidations. The investors who survive and profit through market cycles are those who own their positions outright and can hold through volatility. Leverage turns volatility into a catastrophic risk. Third, do not chase headlines or social media hype. Every few months, silver trends on financial social media with breathless predictions of imminent explosions in price. These episodes rarely pan out as advertised, and they attract inexperienced buyers who purchase emotionally and sell at the worst possible times. The real opportunity in supply-constrained markets accrues to patient, informed holders, not to momentum chasers. Fourth, do not ignore your personal financial situation in pursuit of a thesis. I don't care how compelling the silver bottleneck story is. If you don't have adequate emergency savings, If you have high interest debt, if you're not contributing to retirement accounts with employer matches, those things should be addressed first. Physical silver is not going to save you from poor fundamental financial planning. It's a component of a well-structured financial life, not a substitute for one. Fifth, do not treat price predictions as facts. Anyone claiming to know exactly where silver will be in 6 months or a year is either lying or delusional. Markets are complex adaptive systems with countless variables. Predictions are best viewed as possible scenarios to consider, not certainties to bet on. Focus on understanding the forces in play and positioning accordingly, not on hitting specific price targets. Sixth, do not assume the paper price is fake or manipulated just because it doesn't align with your expectations. Yes, there are legitimate questions about the size of paper markets relative to physical supply, but jumping to manipulation as the explanation for every price move you don't like is intellectually lazy and strategically useless. Markets can be irrational, short-term dynamics can overwhelm fundamentals, and large players can influence prices. These are realities in every market, not unique to silver. Your job is to position appropriately given these realities, not to complain about them. Finally, do not isolate yourself in echo chambers. It's easy to find communities online that will reinforce your silver thesis constantly. Everyone agrees, everyone's bullish, everyone sees the same data the same way. This feels comfortable, but it's dangerous. Seek out thoughtful skeptics. Read the bear case. Understand the arguments against your position. This doesn't mean you'll change your mind, but it will sharpen your thinking and help you avoid blind spots. The best investors are those who can hold a position with conviction while remaining open to information that might contradict it. Let's talk about the psychological challenge of navigating a situation like the current silver bottleneck. Markets test your emotions in different ways, depending on whether prices are rising or falling. Right now, we're in a particularly challenging psychological environment. A situation where the fundamental case appears strong, physical markets show clear stress, but price action hasn't validated the thesis dramatically. This creates doubt. Did I miss something? Am I wrong? Should I just move on? These feelings are normal and universal. Every investor who's held a position through a lengthy consolidation or correction has experienced them. Here's what separates successful long-term investors from the crowd. They develop the ability to separate their emotional state from their analytical framework. When you first make an investment decision, ideally you do so based on thoughtful analysis of the situation. You've considered the fundamentals, evaluated the risks, determined appropriate position sizing, and concluded the risk-reward profile is attractive. That analysis either remains valid or it doesn't. Your feelings about the investment are irrelevant to whether the underlying thesis is intact. So the discipline is this. Periodically revisit your analysis with fresh eyes. Has something fundamental changed? Are the supply constraints easing? Has industrial demand collapsed? Have central banks reversed course dramatically? Is the macro environment substantially different? If the answer is no, if the core reasons you found the opportunity attractive remain in place, then short-term price action and your emotional discomfort are noise. If the answer is yes, if something genuinely fundamental has changed, then you should reconsider your position regardless of whether you're up or down. This sounds simple, but it's incredibly difficult in practice. Our brains are wired to avoid loss and seek confirmation. We naturally focus on information that supports our existing views and dismiss information that contradicts them. Building the discipline to evaluate your positions objectively requires conscious effort and often benefits from structured approaches. Some investors find it helpful to write down their investment thesis when they initiate a position. Not just, I think silver will go up, but the actual chain of reasoning. Why now? What has to happen for this to work? What would invalidate the thesis? What time frame makes sense? Then, when doubt creeps in, or when prices move dramatically, they can return to that written thesis and evaluate objectively whether it still holds. Others use trusted advisors or investment partners who can provide an outside perspective when emotions run high. The specific technique matters less than the commitment to maintaining analytical discipline through emotional turbulence. In the context of the silver bottleneck, this means recognizing that physical supply constraints can coexist with frustrating price action for extended periods. The constraint is real, but its translation into price appreciation isn't immediate or linear. Patience is the edge. Most market participants don't have it. They get bored, they get scared, they move on to the next shiny thing. If your analysis suggests the bottleneck represents a genuine opportunity and that analysis remains valid, then your advantage lies in simply not doing anything stupid while the situation develops. One of the marks of an experienced investor is thinking in probabilities rather than certainties. The silver bottleneck doesn't guarantee anything. It doesn't mean prices must rise. It doesn't mean the timeline is predictable. And it doesn't mean there aren't scenarios where the thesis fails. What it does mean is that the probability distribution has shifted. The chances of significant upside have increased relative to where they were before the bottleneck became apparent. Think about it this way. Before the supply constraint became evident, someone evaluating silver might have concluded there was perhaps a 20% chance of a major move higher over the next several years, a 60% chance of moderate movement or consolidation, and a 20% chance of significant decline. With the bottleneck, those probabilities might shift to 35% chance of major upside, 50% moderate movement, 15% significant decline. These are illustrative numbers, not predictions, but the concept matters. The opportunity has become more attractive at the margin without becoming certain. Probabilistic thinking helps in several ways. First, it prevents all or nothing mentality. You don't need to be absolutely certain to make an investment. You need to believe the probability-weighted outcomes are favorable relative to your cost and risk. Second, it naturally leads to appropriate position sizing. If something is a coin flip, you bet small. If the odds are heavily in your favor, you can bet larger, but never so large that being wrong is catastrophic. Third, it keeps you humble. When you think in probabilities, you acknowledge that even well-reasoned positions can fail. You're not shocked or emotionally destroyed when the lower probability outcome occurs. You knew it was possible. It just wasn't your base case. Fourth, it helps you hold positions through volatility. Short-term moves don't invalidate the probability assessment unless something fundamental changes. A 20% correction in a position you evaluated as having favorable odds doesn't mean you were wrong. It means markets are volatile, and you expected volatility. In the context of silver, probabilistic thinking means recognizing that the bottleneck increases the attractiveness of the opportunity without guaranteeing any specific outcome. Industrial demand might plateau if economic growth slows sharply. New supply sources might emerge faster than expected. Financial markets might enter a regime where hard assets fall out of favor despite fundamental support. Paper markets might continue to dominate price discovery regardless of physical tightness. These outcomes are possible. They're just less probable given current information than they were before the bottleneck became apparent. Your positioning should reflect the probability-weighted assessment, not your hope for the best-case scenario. This is why position sizing matters so much. If you allocate 5 to 10% of your portfolio to physical silver, you're making a bet sized appropriately to favorable but uncertain odds. If it works, it materially helps your overall returns. If it doesn't, it's disappointing but not devastating. If you allocate 50% of your portfolio to silver, you're betting everything on a specific outcome in a volatile, unpredictable market. That's not investing. It's gambling with your financial future. The investors who build lasting wealth are those who consistently make well-sized bets with favorable probability-weighted outcomes, not those who bet everything on a single thesis, no matter how compelling. We've covered a lot of ground, so let's bring this together. The physical silver market is experiencing a genuine structural bottleneck. Supply is constrained by mining economics, long project timelines, and the nature of silver as primarily a byproduct metal. Demand is growing from industrial uses that are difficult to substitute and investment interests driven by macro concerns. This bottleneck manifests in elevated premiums, extended delivery times, and persistent stress in the physical supply chain. It represents a meaningful change from historical norms. For those who hold physical silver, this situation validates aspects of your investment thesis. Your metal exists and has become harder to source. Maintain discipline, avoid emotional reactions, and ensure your position sizing remains appropriate for your personal situation. For those considering entering the market, understand that you're not discovering an unknown opportunity. The thesis is recognized. The challenge is determining whether the risk-reward profile remains attractive at current prices and premiums, and whether it fits your broader financial objectives. For everyone, the key lessons remain constant across market cycles and asset classes. Understand what you own and why you own it. If you can't articulate the thesis clearly, you shouldn't hold the position. Size positions appropriately for uncertainty and volatility. No single investment should make or break your financial future. Think in probabilities, not certainties. The future is unknowable. You're making bets on probability-weighted outcomes. Maintain emotional discipline. Your feelings about an investment have no bearing on its underlying value or prospects. Stay informed, but avoid information overload. Checking prices constantly and consuming endless commentary creates anxiety without improving outcomes. Be patient. Structural changes in markets take time to fully express themselves. The most significant opportunities often require waiting through periods of doubt and discomfort. Remember that understanding cycles and preparing appropriately matter far more than predicting exact turning points or price targets. The silver bottleneck is real. It's structural, not temporary. It creates an interesting asymmetry in risk and potential reward. But it's not a guarantee. It's not a secret. It's not going to save you from poor financial planning, emotional decision-making, or over-leveraging. What you do with this information depends on your unique situation your understanding of markets, your risk tolerance, and your financial goals. The best I can offer is this perspective. Stay informed, stay disciplined, stay grounded. In a world of endless noise and hype, these 3 commitments will serve you far better than any price prediction or hot tip. The investors who navigate market cycles successfully aren't the loudest voices or the most confident predictors. They're the ones who understand probabilities, manage risk appropriately, control their emotions, and have the patience to let their thesis play out without constant interference. Whether silver represents an opportunity for you is a question only you can answer. But if you've decided it does, approach it with the seriousness, discipline, and long-term perspective that successful investing requires. The bottleneck is here, the fundamentals are clear. The rest is about execution, patience, and maintaining perspective through whatever comes next. Thank you for your time and attention. Stay thoughtful, stay disciplined, and stay focused on what actually matters, building lasting financial security through understanding, not speculation.